The last two Bitcoin tops were pinpointed almost to perfection by a handful of cycle indicators. Some caught the exact peak within just a few days, while others gave warning signs weeks in advance. Back then, they worked like clockwork, but the very same indicators that screamed sell at 69K in 2021 are showing nothing but silence today. That's why so many believe the cycle top is still months away. The problem is Bitcoin itself has evolved. The structure of this market, the players involved, and the way liquidity flows through it have all shifted. Which means for the first time in over a decade, some of these so-called reliable models are on the verge of breaking down. In this video, I'll walk you through the most popular cycle top indicators, explain where each one stands right now, and separate the ones that still hold weight from those that no longer apply. Stick with me till the end, because once you see how these indicators line up, you'll have a much clearer picture of what's actually ahead for Bitcoin and altcoins in this cycle. If you value honest, realistic analysis without the usual hopium, smash that like button to support the channel. And of course, subscribe if you haven't already. Let's get straight into it. When it comes to cycle top indicators, the first name that always comes up is the Pi cycle top indicator. Many call it the holy grail of Bitcoin indicators because of how accurately it has nailed cycle tops in 2013, 2017, and 2021. That covers all three completed 4-year Bitcoin cycles so far. The way it works is fairly simple but effective. It uses the 111-day moving average and a special multiple of the 350-day moving average. Whenever the 111-day moving average rises and crosses above the 350-day moving average, it has historically lined up almost perfectly with Bitcoin's peak. That raises the big question for this cycle. Should we once again wait for that crossover to trigger a sell signal just like before? In my view, the answer is less straightforward this time. Volatility in Bitcoin, both to the upside and downside, has dropped significantly after the ETF approvals. To put it in perspective, during the 2021 cycle, Bitcoin had over 10 single-day drops of more than 15% between the halving and the cycle top in November 2021. Since the 2024 halving, the only instance where Bitcoin printed a daily candle of that magnitude was during the yen carry trade unwind in August. This shows how different the market structure has become. Still, that does not make the Pi cycle indicator irrelevant. If Bitcoin does enter a euphoric parabolic phase like in past cycles, the crossover could still appear. But in my opinion, the real value of this indicator is not just predicting the absolute cycle top, but giving signals for shorter-term fluctuations within the broader bull run. If you track recent price action closely, you'll see the pattern. Whenever Bitcoin taps the 350-day moving average, which is shown as the green band, it usually triggers a short-term correction. After that, price tends to dip below the orange band, which represents the 111-day moving average. It is not wise to overtrade these fluctuations, but for short-term positions, this tool can be very effective in making use of volatility. For example, during the March rally, Bitcoin touched the green band and corrected. Later in the election rally, it came close again before dumping under the orange band during the post-election sell-off. At this moment, Bitcoin is hovering right around the orange band, which historically has been an undervalued zone. There is also another version of this chart floating around which tries to predict the exact peak using a projection model. I've seen some posts hyping it up because the model points to a 400K Bitcoin sometime in 2026. This is nothing more than over-sensationalization without any solid backing. At the end of the day, these models are built on moving averages, which by nature cannot forecast future price action. They were designed to show the crossover between a fast and a slow moving average, not to spit out price targets years into the future. While the Pi cycle does a decent job of highlighting when a peak could be near, it has absolutely no ability to tell us where that peak will land. Keep that in mind the next time you come across bold predictions based on this chart. I regularly post cycle-related insights and other data-backed updates on X, so make sure to follow us there if you want to stay ahead of the herd. Link is in the description. The next popular cycle indicator is the Puell Multiple. This metric shifts the focus to the supply side of Bitcoin's economy by tracking miner revenue. It is calculated by dividing the daily issuance value of Bitcoin by its 365-day moving average. Historically, when the Puell multiple enters the red zone above 3.4, it has lined up with major cycle tops. That is typically the point when miners start heavy selling, adding significant pressure on the market and triggering sharp corrections. Right now, the Puell multiple is sitting just above 1, which is comfortably below the danger zone. What's interesting, though, is how the peaks have been shrinking with each cycle. In 2013, this index spiked above 9. In 2017, the top came in around 6.6. By the 2021 cycle, it struggled to even touch the danger zone at 3.4. This shows a clear trend of diminishing volatility as Bitcoin matures. If that pattern continues, there is a good chance the Puell Multiple might not even hit the red zone this cycle and could reverse lower once it approaches the 3 region. Moving on, let's talk about the Rainbow Price Chart. This is a long-term valuation tool that uses a logarithmic growth curve to project the potential future path of Bitcoin. It overlays rainbow-colored bands on top of that curve, with each band representing a different stage of market sentiment as Bitcoin moves through the channel. The idea is to highlight where opportunities may exist for investors by showing when the market is in deep value, fair value, or extreme bubble territory. Looking back, during the euphoria of 2017, Bitcoin pushed into the dark red band, which is labeled as maximum bubble territory. In the 2021 cycle, it made it only as far as the FOMO intensifies zone, topping just below the red band. This cycle, we are still sitting within the green band, which is considered the accumulation zone. In my view, the most realistic target this time is the yellow Hodl Zone. Currently, the lower bound of that zone sits around 180K and the upper bound is closer to 250K. And if you want to keep track of this chart along with the other indicators we've discussed, you can find them all on Bitcoin Magazine Pro. They were kind enough to offer the Decoder community a lifetime 20% discount on any subscription. Just use the code DECODER at checkout. That also gives us a small kickback to support the channel. Many of their charts are free to access, but subscribers do get access to some excellent premium data. You'll find the link in the description. Now let's look at one of the more interesting tools out there, the Everything Indicator. As the name suggests, it brings together several of the most important metrics into a single score to give a broad market overview. The result is a reactive oscillator that has historically done a strong job of identifying both peaks and bottoms for Bitcoin. Some of the key inputs include global M to money supply, the MVRVZ score, and a few others, all blended into one signal. Right now, this indicator is showing that there is still substantial upside potential left in this cycle. The score is only halfway to the euphoric zone, yet Bitcoin itself is still about 10% away from its all-time high. In other words, the market is far from overheated. The red zone begins when the metric crosses 85, which historically signals extreme conditions. In both 2017 and 2021, the indicator moved well above that level during the peak mania phase. But just like the other cycle indicators we've looked at, I wouldn't wait for it to play out exactly the same way again. Market structure has matured and volatility has diminished compared to past cycles. At the moment, the score sits around 40. Personally, I would start considering scale-outs as we approach the 70 region, instead of waiting for the absolute euphoria band to trigger. The final tool, and one that doesn't get nearly enough attention, is ETH versus global liquidity. I often highlight this free indicator on the channel because it has been one of the most reliable ways to spot local tops and bottoms. The idea is straightforward. It tracks global liquidity trends to estimate ETH's fair value, and since most altcoins tend to follow ETH, it works as a strong gauge for the broader altcoin market as well. The framework is simple but effective. When ETH moves close to the upper red band, it usually signals that the market is overheated and it's time to start locking in profits. On the other hand, when price falls to the lower green band, that has consistently marked high conviction entry points. A gap of less than 10% from the red band is generally a cue to begin trimming risk, while touches of the green band have historically lined up with major market lows. Buying ETH and altcoins near those levels has delivered some of the best returns across past cycles. Right now, ETH has pulled back quite a bit and sits well below the upper red band, which suggests we are not in overheated territory yet. Over time, this liquidity-based model has proven to be one of the most reliable tools for catching both cycle tops and bottoms, not just in ETH but across the entire altcoin market. I'll leave a link to this free tool in the description so you can track it yourself. As we wrap up, there is something important you should always remember. Successful market navigation isn't about chasing the perfect signal or waiting for a single indicator to sound an alarm. This cycle has proven that models don't always work the way they used to. Back at the start, I said this might be the first cycle where some old models break down. That doesn't mean we throw them out, but it does mean we need to adapt and think in probabilities instead of absolutes. Because the market itself is maturing, the players have changed, and new forces are at play. The real edge comes from watching how on-chain activity, macro forces, and market sentiment all interact. Stay curious, stay data-driven, and give yourself permission to adapt your thesis as new evidence emerges. Never cling to a single narrative. As always, I want to hear from you. What's your personal checklist for spotting cycle tops, and which indicators are you watching closest this time? Drop your thoughts in the comments, and let's build better frameworks together. Thanks for watching, and I will see you in the next one.